Switching gears a little bit, now talking about our reporting season. So, look, noting that we're only 37% of the way through, so there's still some notable large caps that are due to report as well. So Coles, Woolies, Cochlear, Brambles, Ramsay, TPG, to name a few. So there's also a number of our key best ideas also up over the next week, and that's highlighted by this slide here. So we've got Lovisa, Healthco, Hub24, MoneyMe, and Mars Group, to name a few. So all in all, I guess reporting season, as Tom pointed out last week, it's been pretty stellar so far, and results over last week actually continue to emphasise that, with better than average beat rates, both at the large cap end as well as the small cap end. We're seeing 41% of ASX 50 companies beat expectations, 34% of small caps beat expectations, and we're seeing a much lower miss rate for the small caps as well. So despite the majority of the first half really being impacted by the lockdowns in Sydney and Melbourne, as well as then in December being hit by Omicron, companies, as we pointed out in the reporting season preview, continue to defy expectations. And we're seeing that because of that low expectation really heading into results season. So really conservative forecast. They tend to get beat. So what we're seeing at the moment is about 2% EPS revision across the board, with the median revision about sort of 5%. And it goes to show you there that really we're seeing those conservative expectations really play out, and a lot of companies actually beat. On top of that, if we're looking at earnings guidance, like the last few reporting seasons, we're seeing very little in the way of earnings guidance. In fact, only 24% of companies providing some form of quantitative earnings guidance. So again, that sets the platform for some pretty conservative estimates moving forward again. So in terms of price reactions, and we're looking at the stalwarts here, for beats on average, they're around sort of 5% across the market, with notable large cap beats being Computershare 11%, Treasury up 12%, CBA up 6%, and some Suncorp up 6%. So it's both notable as well as surprising to us. In fact, Tom and I were talking about it on Friday, just how notable these large cap reactions have been. I mean, CBA moving 6% on a result. So it's been a while since we've seen that. So perhaps there's also an element of that flight to quality really taking place, the broader macro, as Nick alluded to as well, impacting at the moment. So while on one hand, it's quite surprising how, it's not surprising how the low expectations played out through reporting season and the number of beats. It's also not surprising that the misses, if you're missing low expectations, you're getting punished quite hard, so down 5%. But thankfully, again, with the misses, they've been few and far between. Really, the notable ones are QBE and Wesfarmers. So Wesfarmers down 8% and QBE down 9%. But again, if you talk to the analysts, they have been hit by a spate of one-offs. So nothing there to worry about in terms of their longer-term growth profile, really to do with some of the short-term risks around Omicron there. So fundamentally, I guess all in all, it's been a pretty good reporting season so far, strong earnings performance across the board, and particularly with the large caps, just how well they've performed really paints a strong backdrop for the market, we think, this year. And it's notable some of the commentary there particularly from these market stalwarts, particularly CBA's commentary with Matt Commons saying that that strong economic momentum to carry through to at least the end of 2023. So very strong statement from a bank which pretty much touches every part of the Australian economy. So if that certainly holds, then again, we're likely to see upgrades as we move through the year. So given the lack of earnings guidance, we think modest revisions to FY22 numbers. We've only seen those 2% revisions. And to put some colour on that, the market's only expecting about 3% EPS growth for 2023, so FY23. So not much price in the way of consensus forecast there. So again, really set up for upgrades as we move through this year. I'll move through this quickly. In terms of upgrades and downgrades, we're seeing strong upgrades from all of the key large and economically sensitive companies. So if you look at CBA, SEEK, Woodside, Suncorp, REA, Borals, CPU and Aurora, all receiving some pretty strong commentary as well as some strong upgrades. Downgrades largely one-offs. So I've talked about the impact of Omicron with Wesfarmers business, increased COVID costs there. we've seen some temporary margin weakness for Cleanaway, and we've heard from CTD as well. Obviously, the weaker first half being hit by Omicron, but activity really bouncing back day by day, week by week. So certainly some good signs there. So overall market EPS and revenue revisions. EPS revisions are up around sort of 2%, and revenue up around 1% for FY23. So not much in the way of revisions for the long-dated forecasts. And we're also not seeing much in the way of downward revisions to earnings. So if you put those two together, I guess what it's saying is that the demand environment and what we're seeing in terms of the top-line growth and efficiency gains are enough to offset some of the increased costs. So margins are holding quite steady despite all the talk around cost inflation. So while and Nick touched on this, while the reporting season is fundamentally sound, we're really up against it when it comes to the macro, and it continues to really weigh on some otherwise pretty strong results. So inflation beneficiaries really being the key sectors that have benefited from what's happening at the moment. So banks up 9.5%, insurers up 6%, materials up 4.5%, energy up 3.7%, and REITs up 2.6%. While on the other end of the equation, growth equities have lagged. So IT down 3%, online media down 4%, and biotech down 4%. So no sign, as Nick said as well, that trend is reversing. Certainly, all the inflation beneficiaries continue to do well. So another quick theme, just important to point out, short sellers, they've been quite dormant for a while over the best part of the last 2 years, but they've caught them really well this reporting season. So something to just be mindful of this time around. They tend to, particularly in markets like this, they have positioned quite strongly in some of the high PE names, and particularly some of those high PE names that are coming up in terms of their reporting. So look at your portfolios, I guess, is the key message here, particularly if you're holding some of these key names with big short positions. So the ones coming up in the next few days is Zip, Tyro, and PointsBet, which has seen increased short selling into their results. Finally, on this slide just really highlights some of the results that we're looking out for. So there's a number there in terms of our best ideas, as well as some names that were flagged in our playbook. So names like Hub, MoneyMe, Healthco, Lavisa, and Mars Group, they're the ones in our best ideas. And others to look out for AFG, Medibank, Helios, and then Cochlear and Ramsay on the downside. So all in all, great reporting season so far. Trading updates suggest that activity has really turned around in February. We see scope for upgrades in the months ahead, provided things hold, we don't get another variant. We are mindful of the macro, so timing into some of these high growth names, you just need to be careful of, but generally fundamentally sound for what we're seeing so far. So we'll have the full reporting season report out next week once the results wrap up, but I'll leave it there this morning. Thanks, Matt.